Bitcoin, in addition to being the first cryptocurrency, is the best known and most popular of the more than 5,000 that exist today. It is also famous for its volatility, that is, for its dramatic price rises and falls. Since its launch in 2009, the price of Bitcoin in the early years did not exceed $100, and in November 2021, it reached an all-time high of $67,000. More and more people, companies and institutions are interested in its purchase. The question is whether its popularity is only due to its previous high valuations, or whether there are reasons to consider Bitcoin as good as gold. For thousands of years, societies around the world began to choose precious metals such as gold and silver as money because they have certain unique characteristics. For example, gold is divisible. It can be converted into smaller pieces. It is durable because it does not decompose or deteriorate over the years. It is recognizable, meaning that its authenticity can be verified. It is portable, meaning that it can be moved from one place to another. And it is scarce because it requires a lot of work to extract and refine, so that the supply of gold only increases by about 2% each year, which means that its supply is predictable. Otherwise, if gold were easy to produce, it would not serve as money or a store of value. So, gold is almost perfect. It has been good money for over 5,000 years and has served many purposes. The problem with gold is its difficult portability in large quantities, hence the business of vaults arose to guard those large amounts of gold, and these later became banks, so that the gold was deposited in a vault, and a certified paper receipt was given that said the value that was stored in gold. That paper was then as good as gold because with it anyone could go to the bank to claim the gold. Therefore, with that paper it became easier to make transactions because it meant that the person did not have to carry gold, but a paper that could be redeemable at any time. This system was known as the gold standard, that is, a system in which banks had to have physical gold reserves, so that anyone could go to the bank with a bill and exchange it for gold. Until a few decades ago, there was even a similar system called the gold dollar standard. It turns out that when World War II was ending, Europe was destroyed and the United States benefited on several fronts. One of them was to have become a kind of world bank because they had the largest gold reserves in the world. Therefore, in 1944, representatives of 44 Allied countries met in Bretton Woods, a small town in the state of New Hampshire. There, a plan was drawn up to stabilize the world financial system after the war, and to achieve this, the US dollar was chosen as the world reserve currency and gold as its backing. In other words, it was not the traditional gold standard, but a kind of gold dollar standard, in which all countries fixed their currencies in relation to the dollar, and the US undertook to send the dollar in relation to gold. In theory, every $35 was to be backed by 1 ounce of gold. However, the Bretton Woods system would only last 25 years. The US at that time was incurring heavy expenses to finance the Vietnam War and printed far more money than it could actually back with gold, which led Richard Nixon, the US president, to call an emergency press conference in 1971, announcing that the US was disengaging from the Bretton Woods agreements, that is, from the gold dollar standard. This meant that countries could no longer convert their holdings of US dollars into gold. With this surprising announcement, a new era began, a system in which no currency was backed by gold. Therefore, countries had the possibility of printing banknotes without the need of having any backing, and that is the system that is still in force today. In the past, credibility was given by gold reserves. Now it is based on the confidence that those who have the power to create money do so responsibly. Otherwise, if too much money is created, if more bills are printed, the purchasing power they give to their bills decreases. In other words, inflation is generated and less can be bought with the same dollars. If there is more money circulating in pursuit of the same amount of goods, prices will tend to rise. We are born into a system where most believe that inflation is inevitable, that it is a natural process, that almost everything is worth more year after year. Yet under the near-capitalist system, prices should be lower and lower, thanks to increased productivity and more efficient processes. On the contrary, we are seeing inflation in many parts of the world, reaching historically high levels, coinciding with the fact that in recent years central banks have pumped trillions of dollars into the economy. Although some believe that wealth can be increased by printing banknotes, the truth is that this has consequences. One of them is that there is what is known as the Cantillon effect. For example, when the Federal Reserve, which is the US central bank, prints money, this new money is not distributed equally throughout the economy. Generally, the first to receive the newly created money out of thin air is the government, which uses it primarily to finance its operations, debt repayment and interest on debt. And being the first to receive the newly created money is an advantage because it has not yet had an impact on inflation. Those who do suffer from this expansion of money are those on fixed incomes, retirees, or those who do not have goods that are valued with the inflation that will be generated by the greater amount of money now in circulation. That is, those bills they receive as a monthly salary can buy less and less because there are now more of those bills chasing the same amount of goods. On the other hand, central banks are not the only ones that can create money, commercial banks do it too. Commercial banks are obliged by law to keep in their reserves a minimum amount of money, according to the cash ratio determined by the central bank. For example, if the cash ratio is 10%, commercial banks must keep 10% of the total money collected as reserves. So if a client deposits $100 in a bank, the bank only has to keep $10, the rest can be used, for example, to grant a credit of $90 to another client. And if this customer deposits his $90 in another bank, the same thing happens. In the end, with this coefficient, the banks could multiply this initial $100 into $1,000, and this is also how commercial banks create money. There are ways to qualify this, but it is a potential scam by the current financial system, because what would happen if all customers wanted to withdraw their money from the bank on the same day? Well, the system would collapse because the banks would not have all the money requested. They know this in Argentina with what was called El Corralido, when cash withdrawals by Argentines were restricted. For these reasons, this is a system that is based on trust, on the promise that the banks will deliver the money that was initially deposited. And this is where Bitcoin comes in, a decentralized digital currency that can be bought, sold and exchanged without the need for an intermediary such as a bank. Other currencies such as the dollar or the euro are also digital, but these are fiat currencies, that is, they can still be created out of thin air. In contrast, Bitcoin's supply is limited to 21 million coins. With the current banking system, when you deposit money in a savings account, you are actually lending money to the bank, and as I said before, the bank can create with this money more money. You trust that in the future you will get it back, but there is no absolute certainty. On the contrary, if you have Bitcoin, it is no one else's responsibility. You don't have to rely on a third party to effectively return it to you in the future. That's why it is said that Bitcoin is as good as gold. It is also divisible because, although a Bitcoin is worth more than $65,000, you can buy much smaller fractions of Bitcoin. It is durable because it is digital and will not wear out over time. It is recognizable, meaning that you can verify its authenticity. It is portable because you can send Bitcoin to another person anywhere in the world, as if it were an email. And it is scarce because only 21 million Bitcoins will be created according to the initial protocol. This means that you cannot create more coins out of thin air as you can with other fiat currencies. Even so, it is not certain that Bitcoin will be like gold or that it will replace it, but at least they do have similar characteristics. From there to what might happen in the future is uncertain. Obviously, the idea that Bitcoin could replace gold, which has been used for over 5,000 years, is a very disruptive idea, and it can be frustrating for most of us trying to understand how Bitcoin, blockchain, and the complex world of cryptocurrencies work. Anyway, for now Bitcoin is seen by the general public as a speculative asset, and most of them buy Bitcoin because of the high valuations, the headlines, and the FOMO, which translates as fear of missing out, the fear of losing the opportunity to make money. However, most of its buyers end up understanding the reasons why Bitcoin could change the functioning of the global financial system. So far this video, and thank you very much for reaching the end.